Okay, fantastic. How's everybody doing today? We got the Fed coming up at 2 o'clock, so we have something to do. Let's see. We were just in the chat room. In fact, I should finish this because I was going to make it a top trade. So we were just in the chat room. I want to close that. Discussing our SunPower positions. So SunPower has earnings today. Let's look at it. Now, SunPower is not a really super undervalued company. Just want to be clear about that. So it's not necessarily going to have great earnings today, but if they do have great earnings, it may be your last chance to get in it. So I don't want to not have it. But we do have it. It's been a favorite of ours for a long time. And in fact, if it goes lower, it's very likely to be the trade of the year. If we do the trade of the year and Thanksgiving for next year, and if SunPower is below 25, I can't see why it wouldn't be our trade of the year for next year. It's 32 right now. So if they take a hit for whatever reason, lack of chips or some problem or something like that, it is very likely that we're going to take a much larger position. So what's up with SunPower? 32.77 is a $5 billion valuation, 5.6 billion. Can't ignore the 0.6 if it's another billion, another 10%, I mean. Anyway, so 5.6 billion. They're only making, if all goes well, okay, so this year making 475. They're into an investment cycle for the next 2 years. They're only going to have $100 million or so in profits for the next 2 years. They've got a big investing cycle ahead of them. And they're only going to make this much. But here's the thing. They're not projecting a lot of sales growth. I mean, it's good growth, but it's not through the roof kind of growth. I think they're wrong. I think that you're going to see a lot of government contracts and a lot of push, and that they're in a very good position to leverage this, and they're probably going to do a lot more sales. And it's only going to take just $1 billion contract doubles their sales, or 50% increase that they project out here. So if they get a contract now, and they get some cash up front, and they can build another plant, and they can start providing solar panels in 2022, their whole thing changes. And that's outside management's purvey to discuss, even if they're in negotiations for something like that. People are throwing, I mean, I would say not an understatement that $1 trillion will be spent on solar in the next 5 years, not even 10 years. $200 billion a year is going to be spent on solar projects. There's not enough companies to throw it at. So I think that that's why SunPower is very undervalued, not because of what they're making, but they can make a very nice profit. They did in 2021. Well, they are making it this year. So they can make a very nice profit. This year closed. They're on a fiscal calendar. But they're in a cycle now. But what you're going to see here is they're going to get up to 2023. They'll be at $2 billion, and they'll be making close to $1 billion in profit in 2023. And then people are going to say, why the hell didn't I buy this company? So we just want to make sure we're in it. It's a long-term cycle. People don't understand what they do, but they are the best panel maker. They make the most efficient panels. And if they can get them to come down in price over time, with the chip shortage, that's not happening. The demand for these will go up significantly. So that's what I like about SunPower. That's why we have it in all our portfolios. Not all of them, 3 of them actually. So why? It's not appropriate for the butterfly. It moves too much. When you see this, it's not going to be a butterfly portfolio. So, and that's the thing. See, when people start getting bullish about SunPower, like at the beginning of the year, when people realized how much they were going to make this year, they took the value up to 55, which is perfectly right. If they're going to make it, if they're making 500 million a year, of course, should have a $10 million valuation. But then SunPower goes and tells them, oh no, guys, we're not going to do this every year. We're going to be reinvesting now. We're not going to have much profit for the next couple of years. Everybody bails. So we're like, fine, we'll buy it. And we did. We all these plays, as you can see, were from May when they went down. We added a lot of SunPower because this was crazy. I mean, it's, you know, we played them in the past where they were too expensive here, but they come back down to 20, and we were like, yeah, let's buy that. So in the futures now, so I'm sorry, they weren't appropriate for the butterfly. They weren't appropriate for earnings. I mean, they would have been appropriate for earnings here, but for whatever reason, we didn't put them in earnings at the time. They're in the, there's another portfolio, and they don't pay a dividend, so they're not in the dividend portfolio. But futures now, yep. Futures now portfolio, they're a big position. $75,000 position. It's only at 32,000, so it's going to more than double. And all they have to do in this position, and now understand that you can do these nice conservative plays. We're only betting they're going to go to 35 at the end of next year, and it's currently 32,000. So if they hold there, if they get to 35 and hold it, it makes 100%. So if the stock goes up 10%, not even 10%, you make 100%. That's great leverage. And what's your downside? Your downside on this one is you have to own 2,000 shares at 20. 20 is way the frick down here. That's where we came in. I don't consider that a penalty. So there's nothing wrong with this trade. If you want to make 100% on your money over the course of a year, this is a great trade. In the long-term portfolio, we basically have the same trade, except we have 75, 75, and we're a little more aggressive on the short puts. And this one is 112,000, 42,000 net. So the upside is 69,000, which is 164%. And again, because we're more aggressive here. And the money talk portfolio, we only have a small position, but it's still nice. It's currently at 87.50. This one we took, we were more conservative, and this is what happens when you're more conservative. We were more conservative. But look, 13 minus 8 is what, 5? So say 5,500 minus 3 is 2,500. So this was a $2,500 entry on a $15,000 spread. We're already at 87.50. We're already up more than 200%. And there's still another, almost 100, not 100, but another 85% or so to go. So that's still a good trade. And on that one, they only have to stay over 25. How crazy are options that I can construct this trade right now, and the net price right now is 87.50, right? 28 minus 8 is 10 minus whatever, and 87.50. So the net price is 87.50. It's freaking $7 in the money. It's $7 in the money, and if it stays, if it doesn't, so SunPower doesn't drop $7 in the next year, which is what, 20%, more than 20% of the price. So if it doesn't drop 25% over the course of a year, you make 100%. That's crazy. But this is what's great about options. It's just unbelievable to me when I talk to sophisticated traders, and they don't like trade options. They think, oh, options, those are too dangerous, blah, blah, blah. I'm like, how is that dangerous? How is it dangerous to where your position, instead of buying SunPower for $32, I'm constructing this trade. So I could buy 1,000 shares of SunPower at $32 and say, ooh, I don't want to do options. Or I can sell 5 puts, only obligates me to buy 500 shares of SunPower. I can do 15 of these, and my upside is $8,000. Now, if I bought 1,000 shares of SunPower, it would have to go to 40 for me to make that money. Here, it only has to not be below 25. How is buying a stock better? How is it not better to do the options? There's no downside to this compared to buying the stock. Of course, there's a downside to everything. There's a risk. The risk is the stock goes to zero, it goes bankrupt. You have nothing. You lose all your money. There's always a risk, but the same risk exists in the stock. That's why people have this. Again, it's a matter of how you perceive something, because the short puts are not riskier than owning the stock. It's a proxy for owning the stock. So if I was going to commit to owning 1,000 shares at 32, why wouldn't I commit to owning 500 shares at 20? There's no logic to me saying that's riskier. And instead of tying up $32,000, I only tie up $87.50, and I got a 60 something upside, 62.50 upside, right? Get 62.50 upside. Anyway, but that's not what I would use a new trade as a new trade. I said the leg I would add, since the money to our portfolio, I'll explain it to people who don't know. The money to our portfolio, we only do adjustments when I'm on the show. I'll be on the show again, in fact, in I don't know, maybe the week before Thanksgiving, I think, something like that. Either the week before or the week after Thanksgiving, so they can do my trade of the year, which might be SunPower. If SunPower goes lower, SunPower is likely to be my trade of the year. That's why we're jumping all over it ahead of earnings. So money to our portfolio, we can't make an adjustment. I wish I could, though. That's what I'm saying. So since this is what I would add to the money to our portfolio if I could, and because it's got plenty of cash, it's up 107%. It has a 207,000. It's up 107%. It started with 100, and 167 is cash. So we're floating in cash. And do I have a trade idea that's more likely to win than this one? No, not really. I'm really gung-ho on these guys. So especially going after 2024, I think that people start realizing what's going on here. So this spread, here we're doing the 30-40 spread with the 25 put. So we're being a lot more aggressive than we are on the ones above, but that's a year later, and we've already seen, again, we're at the downside. Oops, where is it? What did I just do? Oh. No, it was 50. It totally got away from us. This is what I worry about. I'm not worried about it going to zero. I'm more, if it goes to freaking 20, I'm buying much more. If the downside to me is if it gets away from us and does this again, because it went up really fast. Where's Yahoo? Yahoo. No, 2 years. So the real downside here is this is what happened to us. Is we were in SunPower. It went nuts. We got out because it was too nuts. We were so in the money that our spreads were no longer going to make much more money. So there was no point. So we got out. But the point was, I wish we had more at the time. I was like, oh my God, we don't have enough SunPower. We were gobbling it up when it was down here, but then it took off real fast. I mean, this is September, October, November, December, January, February. So 5 months went from 10 to 50. And you know how it is, because when it's 10 and it goes to 20, you're like, oh shit, I'm going to wait for a pullback. But then it goes from 20 to 30 and there's no pullback, or it pulls back to 25 and you're like, 25, okay, maybe it'll go to 20. Nope. Instead it goes 40 and then right to 50, like 40, 50 practically with no break. It's the same company. I'm sorry, I'm eating some edamame. It's a little noisy, probably. It's the same company. Everything is the same. Nothing bad happened to them. So at some point, these guys could fly higher. And that's what I worry about. I worry about missing the next big spike up. So even though earnings may disappoint, and I'm not expecting any great things from them for the next year or so, I do worry about missing this boat. And so we're taking the 30-40 for 2024. If they go lower, I'm very happy to change it to the 20-40. And then when 2025 and 2026 roll around, I mean, that's the problem, I think, is I'm what's this? Don't do that. I think the problem is that I'm already thinking like 2025, 2026. I'm here for the long haul. So I don't care if it goes lower. That's just the way we're going to get more of it. Anyway, so the point being, so now we have SunPower in 4 of our portfolios. and really in all the portfolios where it would make sense to have it. Otherwise, you know, we've got the short-term portfolio. Well, here's our list. We got butterfly dividend, doesn't work for either one of those. Earnings is what we're putting it in. Future is now, it's already in. Long-term, it's already in. Money talk, it's already in. And short-term portfolios for shorts. So it's in every portfolio where we can put it in at this point. Oh, I was gonna make this a top trade alert, I forgot. All right, hang on. See, I didn't realize this is. I'm bored. I'm writing this. You have no idea how long these things take. I was getting into this and doing my whole analysis, but then I suddenly realized it was 1 o'clock already. Create here. See, create it. This is what happens. So after we do a thing in chat, that's the only way I make a top trade. The only way I make a top trade is if it's already been in chat. So we create a top trade. And then we wait. Hope it's gonna work on this computer. Oh, that's annoying. Come on. Oh, here it goes. All right. And it does this for me, and this is how I made this. So I do that. And I write SPWR. New SPWR trade that can make up to 3,900% return on cash ahead of earnings, 2-year play. B. Okay. Now that's what's going to come out. That's the SMS content. That's what's going to come out in your text. Oh, you see where it says howdy, Phil? It probably says howdy, your name, up here on the top. So if you are not getting text alerts, you click on there and there's all these different choices for how you're going to be notified of things. So you want to make sure that happens. And then we publish it and we say, yes, we did intend to make a top trade alert. And now it's officially a top trade alert. And let's see. Yeah, I just wanted to relate because P-Man said something about it in the chat, and I was just like, look, I forgot because I wanted to make absolutely sure we have a lot of SunPower, and we do have a lot of SunPower. I mean, you know, there's just, here we got, what, 40-something upside, and here we have 60 upside. So we'll make 100, 110. And now we added this one, and this one has how much upside? I forgot. 24,000. So we'll make about $130,000 if SunPower gets to 40. That's pretty good. And the downside is just owning SunPower. I don't mind that at all. And JC says there's a big drop in Activision today. And is it worthy of a spread? I don't think so, but we'll see. Let's see. The big drop in Activision is because they're withdrawing Warcraft from China, they're giving up. So a lot of the implied future value is not on the table anymore. But this is kind of an overreaction, maybe. They've been trending down all year. This is I'm sure they're China things because of the restrictions, and they couldn't sell the ads like they wanted to, and they couldn't. Maybe they were getting restricted on selling their in-game crap. They make a lot of money selling stuff in the game. Oh, there's a great parody show. I think it's called Vision Quest, Mythic Quest. I don't know where it is. It's on Apple TV or Hulu or one of those things. But I don't even know what channel I'm watching anymore. Because I finally broke down and got a smart TV. I never had a smart TV before. I had dumb TVs. I use TiVo all the time. I used to use TiVo for everything. So, but on TiVo, you still have to be aware of what channel you're watching because you have to find your shows. On the smart TV, you find the shows, but you don't know what channel it's coming. You don't even know what channel it's coming from half the time. So, it just puts up a screen full of crap. Apple TV does that too. It puts up a whole screen full of crap and just shows you like a whole bunch of shows that you had at some point shown interest in. So maybe at some point I pick Mythic Quest as something I might want to watch. But it says, look, all these shows that you can watch. And it doesn't really tell you where they're from. So it's kind of harder to tell someone, I like the show. And they're like, well, where is it? I'm like, I don't know. I finally have that conversation a lot with people now. But anyway, Mythic Quest is the correct title. It's like it's a comedy thing. It's a sitcom about people who work at basically Activision. I mean, it's very thinly disguised thing of Activision. It's very funny. But anyway, so one of the big things is the guy who sells the crap, the guy who comes up with different ideas for like these things that people want to buy. And it's like a better hammer or a sparkly thing or whatever. People love buying shit in these games. My daughter was making money selling stuff in the game. It's like too crazy. Like she would be on eBay and she was able to make outfits. She's an artist. My older daughter, Madeline. So she's an artist, and she was getting very good since she's been playing Warcraft since she was like 5. so now that she's 20, she's a world-class crafter in Warcraft, and she likes to make outfits for people because she thinks it's cool. People run around the game wearing stuff that she made, or outfits or special whatever. I'm not sure exactly what you're doing. But anyway, people buy her stuff. So she actually makes money selling these things on eBay. Like people pay her real money, then they go to the game and she makes something for them and gives it to them. It's crazy. Anyhow, so meanwhile, these guys make plenty of money selling their own stuff. And it's a rental. Oh, that's also smart. For a long time, they were one of the earlier companies to adopt the model of a monthly subscription. So you pay for the and they have the other games and sales and so on and so forth. Obviously doing very well. There's a new cycle of video consoles coming out. They'll have a good ramp up. So bottom line, $60 billion. That's so funny. $60 billion for a game company. But they make $3 billion a year, so you can't say that they're a bad valuation. This is now a good valuation. They've been a bad valuation for a very long time. Just always remember, it's not your job to save the market. So you don't want to be the first guy to say this is the bottom. Whoa. Man, that is a bad reaction, huh? Ideally, we'd love to see it come back to those 2019 levels. It's like 55, 56. But you don't jump in the day that the thing drops like that. It's only dropping like that because they're bargain hunting. It went from 80 to 65 is 20%, right? How much does that drop? 20%, basically. So it's going to bounce off of 20%. It's almost impossible not to find some support there. I mean, if it was a market, it would have tripped circuit breakers already. So there's some buy program still sitting there at this old breakout level, and that's what's coming in. That's what's holding it up. But if they run out of money, but if you run out of buyers before you run out of people who are still trying to sell, because what happens when you hit these levels? Everybody's trying to sell, lots and lots of people are selling, there's not many buyers, and you get to this level finally, and buying kicks in because somebody had to buy at 65. So somebody had picked the 65 line, which you can see why was the breakout point back here. So somebody had to buy it on Activision at 65. The question is, who's going to get overwhelmed first? Will the sellers get overwhelmed and stop selling, and this buyer is going to come in? But that's not that likely, is it? Because you don't know how big the buyer is or whatever. But the point is, it's not as likely that the sellers who own all the stock, right, are going to get overwhelmed before the new buyers come in with fresh capital. So you certainly don't want to be the first guy to sit there and say, oh, I'm calling the bottom here. If you thought it was down for a stupid reason and you finally see buyers, that's a different story. If something's down and you say, oh, they shouldn't be down at all for that, that's when you can jump in. But like Bed Bath & Beyond was up 100% last night, and I was like, I wish I could short it. I would have liked to have gone on and shorted it last night at 100% up because that was stupid. Great news, great earnings, everything's perfect, but give me a break. It's not that good. So here you'd be saying, no, it's not that bad. Now they've already been down. So they've been trending down. They bounced ahead of earnings because somebody was betting earnings wouldn't be so bad. Then they got the report and it sucks. So it's as bad as expected, and this trend was going to go this way anyway. The question is, when will it stop? And it's probably got to be. If it went down 20 already, I would not be surprised to see another 10, which would take you down. You're going to hit about 55. I'd say 55 would be a great bottom to start buying. But mostly it's on the China thing, I think. Excuse me. Holy cow. There are Activision. See if there's any news. Gloomy forecast. Ooh. Open a new window. Gloomy. I want to see what gloomy means. Oh. Are you giving me a hard time? Okay. Company forecast Q4 adjusted 2.7 versus 2.93. That's not okay. Not gloomy enough to drop that much. Jen O'Neill is stepping down just 3 months to focus more on diversity in the gaming industry. That's interesting. It's another. See, this is all. I'm telling you, it's about this company. It's that Mythic Quest that addresses the same issues. So she steps down from her co-leadership position because she wants to focus on diversity in the gaming industry, and they replaced her with a guy. Oh no, wait, I'm sorry, he's leaving too. Wait. Oh, she's leaving the end of the year, right? So she's replaced by a guy. I like that. Company posts adjusted sales, blah, 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 in line. Stock down. How does that match the headline? Gloomy Q4 forecast. Anyway, so you'd want to read more about it and find out exactly what's going on. But honestly, I think, yeah, you're probably right. That's a good opportunity to step in on this thing. I mean, I certainly would start looking at selling some puts. And what puts could we sell? Keep our eye on the clock for the Fed. Activision 2024, we've got blah, 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 blah. Let's see, they're at 65. We don't mind paying 55. So I would go for the 65 puts. What the hell? So these I keep an eye on. These are going for like $11, $12 range probably. That's nice. And then so then you say, okay, what if it drops $10 more? Because that's our goal. If it drops $10 more, then it's going to be the price of the 75 puts, which are like $17, maybe $17.50. So obviously, if the 65 puts get to $17.50, you definitely want them. But let's say 16. So if you're really gung-ho to get into Activision, I would offer to buy those puts, to sell those puts, sorry. I would offer to sell the 65 puts for 16. If they have a spike down and they fill, you're great, then you don't care. Because your net would be what, like if you're selling 65s for 16, your net is $49. And that's something we could certainly live with. I mean, I don't see how this company is really like completely falling apart. They're just not going to expand at the rate that people thought. I don't think that's a terrible thing. All right, so how's our other stuff doing? Ooh, Dow's down a bit, isn't it? Look at that. That's not pretty. Dow's down, the S&P. Oh, you bastards. So the one I bet on is, although I took the bets off because when we hit this pink line, that was plenty of money, maybe like $5,000. So so we bounced off there. I lost interest at that point. But look how, the Dow came down much better than that. Let me put these back into order. I don't like it like this. YM, you should be ES. And you should be, what should you be? The NASDAQ. You should be the Russell, and you are the Russell. Congratulations. All right, so Russell got rejected at 24. That was very predictable, of course. Nothing exciting going on there. Oil went down further than I thought. So this morning, 82, we were bouncing off 82, and I chickened out. And had we got back, well, this is pre-market, so I mean, I took the money at 82. But had I been paying attention, which I wasn't, it went down nicely below 82. Failing 82 is a very bearish sign. It came back to 82 and then failed that. That was a great time to make a re-entry play. When you fail a key support and then you go down and then you come back and fail it again, you can play it down from there because you're probably going to go and retest again. And that's where we are now. So this is just a failing thing. We are going to get back towards 80, I think, on oil. We can see what that thing says. EIA. Here it is. October 29th. Does that sound right? Oh, yeah, it does. It seems like a long time ago, right? So blah, 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 blah. So we had a 3.3 million barrel build in oil. And gasoline, gasoline inventories, gasoline was down 1.5, but this will wipe that out because they were up by 2.2. So on the whole, just basically a 4 million barrel build overall. And you look, see if anything's weird. Oil, 4 million, 1 there, change, 2 up. Distillate, other oils went down. And the SPR, oh, look, oil came out of the SPR. That's interesting. $2 million barrels came out of the SPR. Since last year, 27 million barrels are out of the SPR. So they are releasing, apparently, 500 barrels, 500,000 barrels per week. from the Strategic Petroleum Reserve. So I guess they're trying to ease things off a little bit. Imports down a bit. Now that's interesting because even though, look at oil, went from 3.6 to 3.2. So that's 400,000 less barrels per day imported. That's 2.8 million barrels less imported for the week. So there was less oil coming in. There was more oil going out, 200,000 more barrels, 250,000 more barrels a day going out. So another couple of million barrels there. So basically, this is worse than it looks. That's why you're getting such bad reaction from oil, because we exported more, we imported less, and we still had a build. You know, and this just goes back to what we were talking about for the last few weeks. This is fake demand. It's not real. There's not really some huge surge in demand, and there probably never will be again. You've seen the peak demand for oil because everything is gearing towards nobody's putting in a power plant that consumes more oil than the previous plant. Nobody. Nothing new consumes more oil or more fuel than the thing before it. It's no, what would be the point of buying the new thing? Everybody's trying to have less. Everybody's trying to emit less. So if you're going to take a bet on whether or not there's going to be more oil sold and more coal sold and so on and so forth, it's not going to happen. The demand growth isn't going to be as much as they are trying to project. You know, global population growth not growing that fast. And we're trying to be more efficient. The efficiency curve, here's how to look at it. The global population, let's see. You know me, I get stuck. I have to know the actual fact. Global population growth rate. Oh, I'm not the only person who asked that question. 1.5% a year. Thank you, Google. 8 billion people. It's a lot of people. Look at this. This is cool. I'm sorry, I gotta see this. No. Explore the map, thank you. What the hell am I looking at? Year one. That's so funny. Wait, I can't see because this thing's in the way. Go away. Year two, year three. Oh, you can put in the year. Okay. Year one. 170 million people. That's a lot of people, actually. Minus 1,000. That doesn't make any sense. Oh, it doesn't do minuses. So from 1 to 1,000. Well, that's fun. Look at that. So year one, 170. Year 10, 170. Year 100, 176. Year 1,000, 254. And then, so let's say 1,500. Only 426 in 1,500. That's interesting. So in 1,500, who are these people? Does it tell you? The American Southwest, largest population of Indians prior to European contact, blah, blah, blah. Cool. Can I get out of that? Yeah, this is a great map. I could spend all day on this. Holy crap. I'm like, who are these guys? And it tells you. Okay, so 1,500, this is cool. So here's 1,500, and we had 426, 1,600, 537, 1,700 should get interesting. No, isn't that weird? 1,700, 585, and America's still empty. Who are there's sorry with some people out there. That's pretty strange. Look at this shit though. Holy crap. Everybody was here. Isn't it funny, like Europeans like running around like thinking they own the universe, and meanwhile everybody lives here. You pompous assholes. All right, let's see. 1800. 1800, still everybody lives here, but now some people are starting to move in around here. 1800, a billion. Here's where we hit a billion, was 1800. 1900, 100 years later, only 1.5 billion. Isn't that crazy? I look at people moved in. You know, you could study this chart probably and like come up with like where to invest for the next 100 years in real estate. If you really like get granular about it and start doing this like 1 year at a time and pay attention. So there we are at 1900. We had 1.5 billion people in 1900. And then, well, let's see. I mean, 1950, 2.5 billion people, still not crazy. Then 1970, 3.6. Can you believe how much this thing's accelerated? And then 1980, 4.4. That was a productive the 70s, man. Man, that's why they killed the free love thing. Holy cow, I didn't realize that. That's why they cracked down on us, man. It's like way too many people. So 1970s, we had a lot of people. Then 80 to 90, 4.5 in 80. 5, another almost a billion, 90. I still don't see how we get to 8. 2000, 6.1. 2010, no, not 2010, sorry. 2010, got to do that now. 2010, 7. Wow, we added a billion. Yeah, I guess that's what it was. We started adding a billion every 10 years. And then 2020, 8.5. Oh, 2030 is a projection. 2020, there we are. And so in the next 10 years, oh, here you go. This is nice. Tells us our future growth. 30, 8.5, 40, 9.2, 50, 9.7. This is not slowing down, people. Wow. What's 2100? No, it won't go there. Wait, nope. Nope, won't accept anything after 2050. Okay, so we're going to hit 10 billion people basically in 2050, which is not terrible considering the way we usually grow. All right, so anyway, so 2 billion more people by 2050 is 30 years, so we are growing by 70 million people a year, basically. It's not many, right? 70 million people is all we're growing the population. Is that right? 70 million. Yeah. Look at that. All these poor Indians. That's terrible. Greenland's still open. I'm liking Iceland, man. I'm telling you, global warming and shit. This will become a nice place. These will be beaches. This will be old beachfront property. I guess it's technically beachfront property now, but it's not the kind of beach you want to be in. All these countries are going to be cool too. It'll be nice, like middle temperatures. I've been in Stockholm. I've been in Copenhagen. I love both of those places, so I could imagine them if they were warmer. But the problem is all these people, this is the problem. All these equatorial people, well, the equator's down here really, but all these people in this band, these guys are smart, they're staying away. But all these people, actually they're not smart, it's just as bad here. All these people around this band around here have to move. This is not going to be inhabitable anymore. So we're going to have 2 billion more people, but all these people are going to have to go up or down. And I guess mostly up. That's where the land is. So this is where you make your purchases, guys. You know, get northern Canada, and this you'll see. Because where the hell would these people go? They can only go up here or up here. Is Africa that empty in this part? That's crazy. It's like completely devoid. Anyway, so what were we talking about? I don't remember anymore. Population, people, numbers, electricity. Right, peak electricity. There you go. So, wow, I actually remember that. So we are adding 1% more people every year, right? But 100% of the people are being given more efficient devices every year. So if you, on the aggregate, each year are able to save 1% on your energy use, you offset all the population growth on the planet. Now, that sounds like a lot, but it's not really, because if you think about it, we used to have regular TVs, cathode ray TVs, and they used a lot of energy. The new TVs are flat screens, use much less energy. And that wasn't even on purpose, that's just the way technology moved. Nobody's buying a TV based on the electric consumption. But now we're becoming conscious of this stuff, and we're having a 2-week meeting with all world leaders, not these guys, not China, not Russia, but most of the countries are at this meeting, and they are dead serious this time. They are really going to do something about climate change, and that means constantly making people aware and constantly pushing every manufacturer of every product sold to figure out how to be more efficient, and also the people who generate the power, so on and so forth. Everything's going to be geared towards energy efficiency, and so that means that. And they want, don't forget that they want to cut CO2 emissions to 0 by 2050, because if they don't, we're all dead. So that's kind of a good goal. They need to cut the greenhouse emissions down to 0 by 2050 for us to like not have incredible catastrophe. We're gonna have a catastrophe anyway, but to not have a horrible, horrible catastrophe. That's what they need to do. And that means over the same 30-year period that the world will hit 10 billion people, they are going to cut now 10 billion is 25% of 8 billion, right? 25% growth over 30 years. But they are going to cut the energy consumption of the 8 billion people by a lot more than 25%. And not only that, so in other words, that will offset the growth, but not only that though, but the new people being added will only be added at 75% of the current usage per person, because they're going to be being cut down anyway also in their energy consumption. So can we achieve that? Yeah, of course we can, because we already drive cars that are probably twice as efficient as the cars, certainly 30 years ago. 30 years ago was freaking 1980. As crazy as that seems, it was 1980, 30 years ago. In 1980, you had a car that got 15 miles a gallon. You were happy with that. 15 miles a gallon was like, hey, that's fine. That's what a car gets. So now you're getting cars with 30 miles a gallon. You cut 50% of your gasoline consumption right there. You didn't even try, right? We're doing the LED light bulbs, things like that, more and more. So it is very possible, very probable, in fact, that we will all be able to cut our consumption faster than the population grows, which is why when they tell you how you're going to need all this electricity, blah, 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 it's a factless argument, because the reality is this is the population growth of the world. We're only growing the population at 1%. And that may step back a little bit. COVID, aside from COVID, just as conditions get worse, people tend to have less children if they have a poor outlook for what's going on in the future. So we may not get the kind of growth that people are worried about. So like I said, though, if you think about it, if you cut your consumption of energy, if 8 billion people cut their consumption of energy by 25%, right? That's 25% less energy. And then there's 2 billion new people. That would be even, except for the 2 billion new people wouldn't actually be using the same amount of energy that the 8 billion people were in the past, because the 8 billion people cut 25% of 100, and the next 2 billion people are not using 100, they're only using 75%, because they're coming in with the more efficient devices, so their consumption is down. So therefore, total consumption goes down anyway, and very likely we're going to be cutting a lot more than 25% of our energy consumption. I mean, really, they're trying to. I mean, they're looking to cut like 50%. They want, or at least it'll all be clean energy consumption. But that's what I mean, though. Even if we don't cut our consumption much more than that per se, the thing is, though, the makeup of that energy use, it will not be fossil fuels. It's not going to be coal. So there'll be a shift also. There are new sources of energy, and whether it's wind or solar or whatever the hell it is, it ain't going to be coal. It ain't going to be oil. And that means that these are bad bets. This is not a good future bet. The growth of the energy industry, the growth of these companies is not a good future bet. 5, 10 years, not much. There's not going to be a lot of change, but over 30 years, you're going to see drastic changes. So the companies that aren't positioning themselves to be different, and I would say I like Total, the big European company, because they're like every new thing they do is clean energy. They don't do anything more in old energy. They do all clean energy projects. They want to be the leader. They're smart. They're like, we're a massive oil company. We have all this freaking money coming in, but we're not gonna open up another oil well. We're not gonna start more rigs. What we're going to do is let these guys run down, but all the new money goes into projects that we want to be into in the future, like solar power, wind power, things like that, hydropower. They want to continue to be a power company, but they don't think the future is going to be oil. And it's a great decision they made. I don't know how they're doing lately, but I do like them a lot. We got out of ours. We made too much money, and we stopped investing in them. So maybe they came down a bit. What? Oh, TTE. That's right. They changed the name to TTE. Wow. So, that was earlier. So 2 years. Oh no, that was a long time ago. That was back in 2020. So this is when we bought them, when they were down here last year, and they went up, and we took the money and ran it 50. But they're probably still a good buy. I don't think there's anything wrong with it. Meanwhile, what's the Fed saying? What's going on? We got our Fed announcement. Blah 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 blah. I love this thing. I should bookmark this. Hang on, let me bookmark that. Add bookmark. Not to Dell. Just put it in my one of my bookmark parts. Just put it in my other bookmarks. I like this. This is a great map to play with. So what was I going to do? Oh yeah, the Wall Street Journal. It's time for the Fed. Drum roll, please. Markets are popping. Getting a pop. Thank God I got out of this. Let's see what's happening. Fed dials back, plots an end to stimulus by June. Interesting. And the market is happy about this? Approved plans to begin scaling its bond buying program this month and end it by June. Wow, this is an aggressive change. Fed officials in their post-meeting statement said they still anticipated elevated inflation would fall because the reflecting factors expected. Oh, for God's sakes, they're still saying transitory. Supply and demand imbalances related to the pandemic, blah, blah, blah. The Fed cut its short-term rate to near zero, blah, blah, blah. Really? It's completely without content. I mean, seriously? What if I click on this? It's the same article. Wow. I'm dumbfounded. That's the best they can do. Well, nobody's going to have this thing ready yet. Fed statement. All right, so let's go to the Fed. Guess we'll have to read it ourselves. Meetings. What? What's going on here? 2020 Fed meeting. Where is the thing? Oh, there it is. All right. Oh, wow. Ooh. It's a very different statement. With progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. The sectors most, and we just had a big jobs number too for the, not the official jobs number, but a good jobs added number. The sectors most adversely affected by the pandemic have improved, like movie theaters and things like that. But the summer's rise in COVID cases slowed the recovery. Inflation is elevated. Factors are expected to be transitory. Supply and demand imbalances related to the pandemic have contributed to sizable prices. So that's their theory. They're saying that the supply shortages are causing the inflation. I don't agree with that necessarily. I mean, to some extent, yes, but I don't think that's going to change the demand. Deliveries are not causing, people aren't panic buying things. It's just getting hard to get stuff, but I don't think people are just bidding everything up to get it. I mean, obviously some people have to, but, oh, sorry. Oh, that's great. Drops. All right, anyway. Overall financial conditions remain accommodative. Policy measures support the economy, flow of credit. The path of the economy continues to depend on the course of the virus. Progress on vaccinations and easing supply constraints are expected to support continued gains. They make it sound like it's really simple. It's not. Unwinding the supply shortage is going to be a very long, drawn-out process. So if it's transitory, it's next year transitory. Gains in economic activity, employment, as well as reduction in inflation, risk to the outlook remain. So if you're, okay, just get angry when I read these things. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run, with inflation having run persistently below this. Whoa. With inflation having run persistently below this longer run goal, what? The committee will aim to achieve inflation moderately above 2% for some time. What are they talking about? Is it this year? What? This is like a report from 1980. What are they talking about? Long-term inflation expectations well anchored at 2%. The committee expects to maintain an accommodating. Are they freaking insane? The committee, oh no wonder the market went up. The committee expects to maintain a accommodative stance until these outcomes are achieved. The committee decided to keep the target range for the Fed funds rate at 0.25%. Oh my God. I mean, we knew they wanted to change that, but still. Until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2%. Seriously, like it hasn't happened. And is on track to exceed 2% for some time. Not this entire year sometime. Don't forget, the government, the same government has raised this year Social Security payments 6% to stay in line with their bullshit lowball inflation figures. 6%, not 2%, 6% cost of living allowance. And this statement here says 2% over and over, as if repeating it will make it true. In this substantial further progress, the economy is made towards the committee's goals, blah, blah, blah. Okay, so we've made progress, they say. So we're getting close to 2%. We're not there yet. The committee decided to begin reducing the monthly pace of its asset purchases by 10 to, this is not the same as raising rates, of course. This is their asset purchases, by 10 billion for Treasury and $5 billion for agency mortgage-backed securities. So they have been spending, I believe it was 100 billion, 40 billion, securities by 70. Beginning later in the month, they will increase its holding of Treasury securities by 70 billion per month. Okay, so it was 80. So it's going from 80 to 70, and it's going from 40 to 35. So it's 105 and it was 120. So that's how much they've cut back. Beginning in December, the committee will increase its holding of treasuries by 60 billion. It says at least also, that's another thing. It doesn't say only. At least 60 billion, blah, blah, blah. The committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month. Okay, so basically that's what they're saying. They're saying they're going to reduce it by, I don't know, what is 15? It's a little bit less than 15% per month. So let's say 12, they're going to reduce it by 12% per month for the next 6 or 7 months. But they're prepared to reverse that decision at any given time. The Federal Reserve's ongoing purchases and holding of securities will continue to foster smooth market funding and accommodative financial conditions. Therefore, in assessing the appropriate stance, the committee will continue to monitor blah, blah, blah. The committee will be prepared to adjust the stance as appropriate if risks emerge. So in other words, if anything happens, we're going to pull it right back. Don't worry. The committee's assessment will take into account a wide range of blah, 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 blah. Voting were everybody, every single person voted for this, 100%. No dissenting opinions. All right, so that's where we are. And of course, the markets are going to like that because it's very, very baby step of a taper. And as you can see, we got spikies, but I don't think it's that big of a deal. It's just short covering. I did say I wanted to short the S&P again if it got back up here, and I missed my chance. I'm not going to do it right now. All right. So I wanted to short it again if it got back up, and it is kind of at the same place it was at 25. But let's see what happens. Let's give it a minute. But ideally, I'd like to get back in the shorts at 46.20. So let's do that. So I'm going to short them again. Oh, that filled immediately. Holy shit. 46.22. All right. Oh, wow. Okay. So 46.22. And now we'll see what happens. Made $600 already in 10 seconds. Because all this is probably going to calm down because on the whole, nothing new, no changes, nothing unexpected, and they're starting their tapering. It's not a big plus. It's just, pretty much what was expected out of this Fed by people who actually understand what's going on. All right, so what happened to the thing that's, uh-oh. Where'd the question box go? There it is. Okay. All right, well, that's fun. All right, good. So anyway, not bearish, though. It's not bearish, it's not bullish. It's just basically neutral stuff, so we're all fine. The long-term portfolio doing 341, so we actually gained today, as far as I can tell. Whoa, 15,000. That's pretty good. So we're at 15,000 today. We're now at $60-something thousand from where we were the last review. And I don't think the short-term portfolio has been damaged that badly. Oh, nope. Only down 40%. It's about the same as where it was. So it's all gains. We're having some fun here with our portfolios. I mean, the shorts aren't getting crushed. And the longs are super performing. And we're having it's ridiculous amounts of money pouring into this stuff. But that is kind of the idea. Oh, in fact, that's a good idea. Let's look at these top trade things we were talking about yesterday. If in a bullish market, of course, you're going to make money. I mean, obviously. But yesterday we looked at the top trades that we made last year at this time in the fourth quarter of last year. And I wasn't too different last year. And let's see what did the market look like. So last year, 2020, in the fall, I think I was in pretty much the same kind of mood where I wasn't really expecting. Wow, isn't that weird? I didn't realize how famous that was. Look at last year. Last year in 8:30, we started having a drop, and this year, here's 8:30, and we started having a drop, and then we went back up, and then we went back up, and then look what happened. Look what happened after early October, though. We didn't do that though. October this year we've been going up. Here we had another drop in October. So here we went up, and then we had another fallback in October. But then we had a really good end of the year last year. And I guess people are kind of more remembering that than this horrible thing. So we're, look at this, these are weeks. So up and up and up every week. Seriously up, like starts a week here. These are what candles tell you. Starts a week here, had a little spike down at some point, but ends a week here, starts a week here, ends a week here, starts a week here, ends a week here. I mean, it's really crazy, man, crazy stuff. Interval 1 week, right? Correct. So what was I going to say? Yeah, last year. So last year at this time, I thought this would continue. I thought we'd have more of a sell-off last year than we did. We didn't. So I was cautious in the fourth quarter, and I was not at all happy in December when we went up and up for no reason. So we did buy on an October dip, though. We had a busy October. And that just gives you the background of where we were. So October 1st, we're talking about EPD today, in fact. EPD is a energy supplier. They supply, they have pipelines, they have liquefied natural gas, things like that, liquid hydrogen. So any kind of fuel things, they're into all sorts of fuel delivery systems. And it's a good company. We got them super cheap last year. They were only $15 when we came in, $16 when we came in, and we just did a simple spread. We wanted 1,000 shares. They pay a huge dividend, like 8%. So we did it for the dividend, and it was $10,000 on the $15,000 spread. So the spread makes 50% while we wait, and we got another year left on it, and a $1.78 dividend on a $16 stock. So it's like paying more than 10%. But because we reduced our net price, our net price was only $10 per share. Because we promised to buy more by selling the 13 puts, we reduced our price by that, and then we sold the calls and reduced our price. So we were in for like net $10, and we're picking up a $1.78 per share, 17.8% dividend on our $10 entry. That's freaking amazing. So we love that. That was our trade last year. So, and again, remembering, we were in a market that was choppy in October last year, and I was playing things that I was really sure were like good positions, and we were looking for stuff. Now, Jets, interestingly, is the airlines, and the airlines were much, much better earlier this year and have dropped off considerably, but we came in so cheaply at the time. I'm not sure where it was then, but our top trade alert was Jets. And we made a 202.3 spread. It's already out. We already where's futures now? Pretty sure it's out. Yeah. So we already cashed that one in. Ooh, Rewalk took a hit, huh? Let's see. But it's basically on the airline industry. We thought it would come back. It has come back. It just kind of has been disappointing for the summer. But overall, they're looking good. We were watching the trends, and we were just getting some reports yesterday, and it's coming back. It's probably at 85% of where it was before the virus hit, and that's not good. It's not profitable for them. But the future. Don't forget they were minting money. Look at Don't forget these guys were totally minting money. What the hell is it? Oh. So before the crash, Delta was up here at 60. Now they're at 40. Because look at this money. 4 billion, 3 billion, 4 billion, $5 billion. And then they lose 12 billion. It's all wiped out. The whole thing's wiped out. Another 3 billion down tubes this year. But you're not, this is somebody else's problem except for the debt and the cash flow issue. But making 5 billion a year, you have to look at it that way. Let's say they're a startup, okay? They spent 12, 15 billion dollars to start up, but they've got this whole airline. So for $15 billion, you have an airline that's now valued at $25 billion, but it doesn't matter because it's $15 billion. Let's say it's 15 billion spent plus 25 that you're paying for the company. It's $40 billion, okay? So would you pay $40 billion for a company that is currently making $2 billion, not this year, but next year? Would you spend $40 billion for a company that's making $2 billion, 20 times earnings, but has historically proven that they could make 5 billion or 4 billion in the past? All of a sudden, that's actually attractive, right? You kind of got to value it like a startup. You got to look at the company and say, okay, fine. We spent 25 billion for the property, for the airline itself. We took another $15 billion worth of debt on, and now we'll have to pay that out of cash flow for the next 10 years. If there's no more virus instances, this is why we don't have the airlines. This is why we took jets instead of the airlines. If there's no more virus instances and everything goes back to normal, it's a no-brainer. You're basically buying them for 10 forward PE. And that's including paying off the debt. So that's how you benchmark it. You say, okay, my total cost of buying the company is $25 billion. My total debt is $15 billion. And this may not even be all debt. They probably had some cash and so on and so forth, but whatever. And so for $40 billion, do they make enough money to justify it? Oh, yeah, they do. Absolutely. They make enough money to justify that. So I'm pretty comfortable with this. And if they go lower, I'd start finding them attractive. As it is now, we felt more comfortable with the ETF because any single airline could always have big problems. And look at United Airlines. And this is what Jets is made of. United Airlines is $15 billion valuation. United Airlines lost $12 billion roughly. So you're paying $27 billion for these guys. And how much can they make? Well, they can make $2-3 billion. So if they can make $3, that's great. Let's say they make $2, though. That's 10 times earnings. I'm paying $12 billion here, and $15 billion here is $27 billion. And they're going to make a couple of $1 billion. So I'm paying a bit more than paying 10, 13 times earnings. I can deal with that. That's acceptable. If they can go back to this, if they go back to this normalized profit here from where they were in the past, yeah, you can't do that, damn it. If I point to it, it goes away. If they can go back to a normal profit thing when they make a couple of $1 billion a year, you're in great shape. If though, but if there's another virus, here's the thing though. I have the same problem with cruise lines. But if there's another virus, if this happens again, then you have to question the whole future of air travel. Okay, let's say it's not COVID. First of all, that's another thing. People aren't factoring this risk. COVID has variants, right? Blah blah blah. Okay, we know that. There could be a completely different virus that we don't even know about because this stuff, the permafrost is melting. The permafrost has every disease people have had for the last 100,000 years locked in the permafrost. So, people get sick, they die, they live in the ice, whatever. Animals carry disease, so on and so forth, and they die in the permafrost, and it snows and it freezes and blah, blah, blah. So there is active bacteria and viruses and things like that we have not seen on this planet for 100,000 years, and they're all coming to get us. No time to react, no time to build up resistance and immunity. These are diseases that died out, and so have the immunities died out from these things from many, many years ago. And as the ice melts, more and more of this stuff starts moving around. plus, yeah, and then animals change their migratory patterns and so on and so forth. That's why they have this thing about the bird flu and the bats and this and that. It's always something anyway, though. I mean, diseases happen regardless, but this global warming situation is certainly not good for that. So something like the Black Plague could come back and bite us in the ass in the next 10 years. Something worse than COVID, even something the same as COVID, whatever. The bottom line is, though, there's a better than 30% chance of something like that happening over the next decade. So if it happens early in the decade, if it happens the next 2 or 3 years, air travel may be doomed, because getting hit by a completely different kind of virus that shuts down the industry for another year, so it's twice in a 10-year period or twice in a 5-year period, something like that. That's something they may not be able to come back from. First of all, they don't have another. Where would they get more money? Where are they going to? They were already $15 billion in debt. They're going to borrow another $15 billion for the next one. And the insurance guys are like, "How are you paying for this? You never paid for the last one. Now you need $15 billion more dollars." And we're like, "Well, we got to fly." And they're like, "Oh, maybe you don't." So the same is the problem with cruises. You don't know what's going to happen at this moment. And yeah, you can be brave and you can bet on this stuff. Everything will be fine, blah, blah, blah. But if it's not, you're going to be pretty screwed holding these kind of things, because it could very drastically change. The whole thing could be seen as a bad idea. That these indoor activities where you jam a lot of people into a very small enclosed space is not going to be a good thing for the future. Or even if the airlines are forced to revamp and change their filtering systems and change their air systems to suck and constantly refresh air, all that shit's expensive. All that, anything like that would cost money. Same thing for cruise ships. It's expensive to fix everything that's wrong with the cruise lines that make them dangerous. We haven't gotten there yet because we're all treating COVID like it's a one-time thing. But what if it's not a one-time thing? First of all, COVID doesn't seem like it's ever going to go away. COVID may, it's going to be like the flu. It's just every year people get COVID. What are you going to do? It's just, that's one of the diseases we deal with in life. You will get vaccines, and hopefully they'll improve the vaccines. Hopefully they'll improve the treatments, but you're stuck with it basically. But what about the next one? The next one could be worse, could be the same, whatever. But if it does what this one did, and it shuts down the parks, and it shuts down the cruise lines, and shuts down the airports, and the cities can't do downtown shopping, blah, 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 all of a sudden you're going to see a lot bigger changes than what we've seen so far. Because people are going to be like, "Oh, this is going to happen every 2 years? Now I got to change my lifestyle. Now we got to rethink a lot of stuff that we do." You're treating this like a one-time thing that happens and then it goes away. Which is what happened in 1918. In 1918, I forget the number, it was like 10% of the world's population died. The Spanish flu thing, which had nothing to do with Spain, but that's beside the point. So that lasted for like 2 years, and lots and lots and lots of people died. But then when it was over, everybody was thrilled, and we had the roaring 20s because everybody was so excited that it was gone. But that's fine, because it was gone and it didn't come back. But we won't know for another couple of years if we're in the clear on this thing. So just be cautious with these kind of bets. That's all I'm saying. Nonetheless, last year, I was betting that it would go away. So we did this play on jets, which made $9,000 so far. And it's 92.45, and it was a $15,000 spread. So it's still a $5,000 left to go. And with super, we're in the money, so there's nothing to worry about really. Not really the money. We're looking for 25. But we have another 5,000 to make on this, and I think we'll come back again. If nothing bad happens, we should be able to keep 25 and get back on there. IBM, you guys know I love IBM. We just added IBM. In fact, IBM was just again top trade alerted last week, I think. So that was when we went with when the chips were down. We went with IBM, and look, that's what I do. When the market is shaky, when we have a sell-off and things are going on sale, I don't look at, I don't look at like Onyx Medical or something like that to say, oh, 50% off, I'm going to buy that. Why? I can buy Goldman Sachs for 30% off. I can buy IBM for 20% off. I'd rather buy a great big blue chip company. And again, we don't need the stock to double to make money. We construct these option plays that pay us an incredible amount of money. Here's the IBM one. Is up 412% so far. The intent of the IBM trade was to make 1,100%. So we're not even on the IBM trade. We're not even there yet. We're not even halfway there yet. Up 400% is not even halfway to go. Same thing for Goldman Sachs. Oh shit. All right. So the same concept with Goldman Sachs. We didn't pick an extra. I mean, it's kind of funny now because they're 400. We targeted 210 last year. That was last year. We targeted 210. Where are we? So blue chip stock, they're certainly going to be around for the long haul. They're going to get bailed out if anything bad happens to them. So we made a commitment to buy. We did this, and we took a $40,000 spread for $10,000 with $30,000 upside. So this one is so in the money that we're basically at goal because it's up 276%. And I said if you cash in early, it's 37.6 out of 40,000. So what's the point? It's only going to make $2,400 over the next. It can only make $2,400 over the next 12 months, and that's 6.3%. You're done. You got to move on. Very important concept. When you've got a trade and there isn't much left in the trade, and you know that you can make more money with like a new trade, take the money off the table and make a new trade. Don't keep your money in dead money. This is like putting your money into a low rate bond or a low rate bank or a low rate savings account. What are you doing with it? There's no reason to keep this thing active anymore. It's just way too far in the money. China Mobile, we lost money. I mean, we keep in mind we only had 4 losing trades in all of our top trades last year. This is one of them. It always pisses me off. And what pisses me off is we lost money not because there's something wrong with China Mobile. We lost money due to government policy. They halted the trading of China Mobile. And still halted. Nobody still knows how this is going to get resolved. So anyway, so we're taking it as a loss and calling it a loss on the thing. IBM again, it's like, because when is this? November 10th. When was IBM? Oh, October 12th. Yeah, a month later, it hadn't. It was still cheap. And that's what I do. I mean, I look and think about like what would be a good top trade, and it turned out like I couldn't find anything better than IBM. I try to find the top trade every week. I don't always. Sometimes I find more. Sometimes I find less. But I look at all the trades and I say, well, is that worthy of a top trade? Is that worthy of a top trade? Blah blah blah. So this IBM trade was definitely worthy because it came up twice. Now, AT&T, I think that's another loss. Yeah, you bastards. But AT&T is potentially going to be a trade of the year. Again, like I was saying before, I don't care if AT&T goes to 50. That's not, we can make 100% on AT&T without AT&T going to 50. In fact, I said here, as a news spread for AT&T, I'm fine with the short puts. The 2024 27 puts. So we're selling the 27 puts for $6. That puts us in at net 21. So of course, that's free money, right? So we're going to sell the 2024 puts for $6, and move into the 2024 23-27 spread, which is only $1.60 net. That's insane. That's a $4 spread, $4.60. And since we're offsetting the cost, this is a roll, so it's different. But if you think about it, you're collecting 6 for this, and you're paying 160 for the spread. So that means that we could do 5 of these. No, 5 would be 8. If we do 4 of these. Yeah, that's right. I'm sorry. So 4 of these would be 640. And then you do so you sell 4, I'm sorry, you sell 4, for each put you sell, you buy 4 calls. So let's say we sold 10 puts, promising to buy $27,000 worth of AT&T, 1,000 shares. So that's your worst case scenario when you sell the 10 puts. And then we could buy 40 long spreads, and they're $44 spreads. And 40 cents. Yeah. And then you buy 40 of these spreads, and that would be 40 times 4 cents buys me a $4 spread. It's net 40 cents for me to buy a $4 spread. That's $2 in the money to start. So where is the point to owning the stock? Where is the point to doing anything other than that? But we're calling it a loss for now. that was another good point of this book. This spread is down $5,200, and it's a $6,000, $6,700 loss, right? So originally, blah 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 blah, it was net $1,500. Okay, we're rolling this spread and spending $4,000. So that means we're spending now $5,500 total dollars, and we're going to end up in a So now we spent $5,500. Well, no, I'm sorry. We put us in the 2024 spread for 37. I'm sorry, we spent $2,800. Oh, I see. It was net because we gained 28 on the put roll, and we spent 4,000, so it was net 12 plus the 1,500 we spent was 3,700. So the net now is 3,700. Now there's no magic trick here. Okay. We have this original $1,500 investment. Forget what the profit and loss is. It doesn't really matter. We spent $1,500 on a spread. We are able to adjust that spread for $2,800 out of pocket. So $1,500 plus 28, that's all the money we're taking off the table. And we end up in a, we end up in this spread, in the $4 spread. And I guess it's I guess it's $20,000 worth of this. We must have 25. We must have 25 of these, right? 50. We have 50. Oh yeah, 50 is 20,000. That's right. Sorry. So 50 of them is 20,000. 50 times 4. And so yeah, 20. So it's a 20. So we're making a $20,000 spread. And the bottom line is, it doesn't matter what we lost or looked like we lost in the past. We didn't lose it yet because most of the loss is coming from the short puts. And once we roll it, it's all brand new. So then we basically, all that matters is we have a total $3,700, and now we're in a $20,000 spread. So these losses are, you can work your way out of these losses. And in fact, in our strategy section, we talk about this, but this is a really good example of how you actually do it. So even when you take a loss, you can then turn it around and say, okay, I'll give it 2 more years to make money. Now, at the end of 2 years, if you make 440% after 2 years, and don't forget we took these 1 year ago, so now you have 3 years to make 440%. You go, oh, that's all I made, you know. It's not a terrible thing, but that's because we start off with sensible positions. It's very easy to continue our leverage. Philip Morris, again, the bluest of blue chips is what I pick when I'm worried about the market. I say, who can I buy that's solid and on sale? And you say solid, well, they just did. But that's not bad. It's not even 20%. They dropped 20% or whatever. They disappointed. As I said, despite taking a huge tumble, they were the target because we came in. We came in at 42.87. They came back to where we came in. But what was our trade at the time? Look how conservative we were. We bought it for 42.87. We sold the $40 calls. I didn't think it was going to go up at all. We just did this for the dividend, and then we ended up with net $3,200. So we paid $32.12 a share. And we were looking to get $40,000 if we're called away. So that was a 24% profit, but we also get $68.80 in dividends. That's what we're in this for. The dividends is as much as a profit on the share. So 32,000, we make 14,000. That's close to 50% for this particular thing. So we didn't need it to go anywhere. We didn't play it to go anywhere. And because we weren't greedy and because we made such a sensible spread, we just sit here and collect our dividends. So we just sit and we collect our dividends, and we don't give a crap if it goes up or it goes down, or it goes up or it goes down. As long as it stays over 40, we're fine. And 40 was $3 lower than where we bought it. We get paid out at 40, our entire amount. We get paid in full at 40. And again, options. This is what you use options for, to do stuff like this. Gilead, another one. Oh, I didn't have a chart for them. That's funny. Is that the end of it? Well, it was. What do you know? So what did Gilead do with my chart? So Gilead also had an up and down sort of year. And what did we do with Gilead? We came in, well, we had a 50-65 spread on Gilead, and they're right at our goal. They're at our target, basically. The short puts are blah, 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 blah. So it's up to, it's so funny, right? When you look back at it, we're up 290%, but it's a $15,000 spread. So it's only net 8,000 right now. It's got $7,000 more to gain if it holds 65. So there's no, so for this one, you're going to make 19% more. Why am I, I'm not going to throw it away. And we started with the spread was $2,000. We started with $2,000. We're now at $8,000, and we have no doubt we're going to end up with $15,000 in 2 years. Now, were there any meme stocks in here? Were there any momentum stocks in here? Were there any popular stocks in here? No, not one. I could care less. What I care about is a reliable way to get a return. If I can see a stock that isn't going to go down, I can construct an options play that's going to make a shitload of money. So why mess around? That's got to be the lesson for the top trade alerts. I'm trying to teach everybody, like, you don't need to be fancy. You don't need to be trading in and out of things. We don't touch these. None of the top trade alerts do we, in a rare case like AT&T, I'm telling you how to adjust it, because of course, if I'm going to look at it, you adjust it, but I don't go back to the top trades and fix them. Set and forget. Buy a blue chip stock when it's on sale. do a conservative spread, and wait for your money to come in. Very simple concept. You want to watch it, you want to actively trade it, go ahead. And like I said, when we put them in the portfolios, a lot of these got cashed out early. They were too high, we cashed them out early. They paid off, we cashed them out early. If it's AT&T or something, we might have adjusted it already. But the bottom line is, you don't have to, because this is what happens when you leave them alone. What happens when you leave it alone? We had, again, 43, 47 total trades, 43 winners, 4 losers. And again, that's without making any effort at all to do anything with them. So 90% of these trades were successful. And again, week by week by week, we're doing one a week, very patiently picking one a week on the average. It's 47, so not even one a week. But whenever we see something really attractive, that's what we get. We ended up deploying, I don't know how much we deployed total, but the bottom line is we made 6 of these 43 winning trades, well, net of the losses too. The total net was $668,000 in profits on these top trades. With boring trades like these. This particular set of boring trades made made $77,000. This boring set from in 1 year made $77,000. Now, it depends when we do them. So usually we give them 9 months to a year before we do a review. Some I try to do them before years up. Anywhere from 9 months to a year, I'll do a top trade review. So probably first. I mean, certainly by the beginning, by January, I'll be doing the review of the first quarter of this year. And then recently, what have we picked? So let's think about what we picked recently. We picked Big Lots, Xerox, Boyd, ABX, which I pick all the time, constantly. Whenever they're cheap, I buy ABX. They're not ABX anymore, but they're gold. Hewlett Packard, Pfizer, SunPower. Speaking of which, right? Viacom, still stupidly cheap. Coin, Pfizer again. And again, this is like the IBM trade before that we were discussing. It was cheap, and then a month later, it was still cheap. So I'm like, I'll pick it again. It's like McFly. It's like, I'm sorry, but if it's still cheap, I'm going to keep telling you to buy it until somebody listens to me. Then Rocket Mortgages, IBM, and Intel. So these were all our picks for this quarter, which hasn't obviously ended yet. We're only in the beginning of November. So basically, October has been crazy busy. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So busy, busy, busy. So why? Because things went on sale for the first time in a long time, and I got all excited. And unlike last year, where in the fourth quarter of last year, we only had 7 picks, or 9 picks. Sorry, there were 9 picks last year. Now we have 13 in October. That's because we had a pullback and we had some stocks that went on sale with their earnings, and we jumped all over them. But look at these stocks. These are not, momentum stocks. These are not these are not things. So Rocket's kind of a new thing, but I think Rocket really is doing something very interesting in the mortgage space. I think they're going to become a huge company. But these are not crazy picks. I think Pfizer had the earnings we expected. I think they took off again. Yeah, see, they kind of blasted up. But yeah, Pfizer was back down here. So of course I picked them twice. I think it was down here, and then it was down here, and it was still down here. And I'm like, oh, I'll pick it again. It's like, I'm sorry, I picked it here, it went up, and then it went down. I'm like, okay, people are that stupid, so let's do it again, and we go up. But that's what you got to do. You've got to have the conviction. And where does my conviction come from? My conviction came from, I think I did the math. I don't know if, I don't want to disappoint anybody if I try to do this, but let's see. I remember one of the Pfizers, I don't know if it was in the top trade, if that's how we presented it, but in one of the Pfizers, I did the math on the viruses. Oh, here's Rocket. Look at that. I got a dissertation on Rocket here. I just really like what they're doing. Oh, they kind of took off also. When did we do this? October 29th was, yeah, like right here. Like basically caught it on the nose, right? So. See, and what drives it? It's like I knew I liked Rocket. I knew I thought they were decent, but then I read, oh, I see what it was. It was a Salesforce thing. Yeah, Rocket Mortgage Technology will be on Salesforce Financial Cloud. Do you know how many people use that thing? Do you know how big Salesforce is? How could you not think that's going to be great for Rocket? And look, and then I said, so there's a huge catalyst for how they can get more business next year. Mortgage origination satisfaction survey. Everybody loves these guys. So you're putting it out on Salesforce. Anybody who asks anybody else in the office or discusses it or whatever says, what do you think of Rocket Mortgage? Oh, they're great. Very, very high customer satisfaction. And what had been keeping them down is a class action lawsuit because these people were pissed. You know, these guys like totally overpaid on a spike of whatever bullshit was going on at the time. Who knows? But the bottom line is these people bought in at a crazy price, and then the stock dropped. And they, of course, they blame the directors and why didn't you warn us? Blah blah blah. So, you know, shareholder lawsuits like that happen all the time. But it's dragged on, and they're just, it's sort of an overhang to the stock. But it's all bullshit. And this company is going to be huge. And if these people just shut up and waited, they'd be fine. Pfizer. Oh, here you go. I knew I had this. So October 18th, Pfizer. Okay, this is what, 2 weeks ago, right? 3 weeks ago, 2 weeks, whatever. Let's keep this in mind. Chart, Pfizer, October 18th. So don't forget, this is the second time I picked Pfizer, but this was to me, this is why I repicked it. I'd say probably somewhere around here. So why did I make my second pick of Pfizer? Because this is the most actionable item from news this morning. Pfizer is projected to have $54.5 billion in COVID vaccine revenue, while Moderna is $38.7 billion. Blah 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 blah. Pfizer's total sales in 2019 were $41 billion and $42 billion last year. So shots last year were not a big number on their revenue. These are forward numbers. This is for next year. $54 billion next year. Now, let's go to Pfizer. When you see a number, you've got to put it into context and think about how will this affect my company. Oops. So Pfizer had sales last year of $41 billion. This year, $80 billion. Now, let's assume that they were flat on their regular sales, and here's the vaccine. So let's say it's $39 billion worth of vaccines. Well, next year it's going to be not 39, it's going to be 54. That means that this number is going to be 54 plus 42, so 96. So this is going to go up to 90. So this number is wrong. These projections are wrong because these are analyst projections that haven't updated yet. This is a report that just came out that day and says, "Oh no, analysts, you're totally wrong. Pfizer is going to be selling way, way more than you think." So this number's off by a mile. Clearly, these vaccine sales are hugely profitable, right? They added $40 billion in sales. They doubled their profit. So what if they go from 80 to 96 billion in sales? That's another $10 billion, not 10 billion, another $5 billion, whatever. Should be more like, this number is going to be more like 28 billion. 28 billion. You can buy the whole company for $254 billion. So it's a no-brainer. We found out something that other people did not know. So of course you invest. That's what you do. And that's why we start off by watching a stock. We sell some puts. We keep it on a watch list. You know, that's what the top of the long-term portfolio is. It's basically a watch list. You know, and these are all stocks we'd love to buy if they get cheaper. But for the now, we're selling puts. So Apple, AEW, BCS, Chimera, Coin. Oh, wait. We didn't. We filled this in. So Coin, we did turn that into a full play. It's not reflected yet. Federal Express, Frontline. The Federal Express, you know, we think the shipping was going to come back, and it's obviously back. Frontline for the tankers. KBH Homes, the biotech ETF. I always buy that when it's cheap. Levi's got stupidly cheap. I don't know why. Moderna is still cheap. Still a great play right there. Metal Steel also cheap. Micron stupidly cheap. Pets is still cheap. Vail still cheap, stupidly cheap. Xerox still cheap. And Yeti's doing. Oh, Yeti's already popped. Look at Yeti. Everybody's asking me why are we doing Yeti? What's going on there? It's like, hey, pretty good already. When we bought it 7.9, we sold the 65 puts on. Oh my God, really? That's funny. What the hell do they look like? Oh, look there. So like when they sold down, when they spiked down on like some bad news or whatever, and I was like, oh, bullshit to that. And we sold puts. We sold puts like way down to 65. Got ridiculous amount of money for them. That's why I like. It wasn't that I think the Yeti's the greatest company on earth. I was just like the options got stupid, and so we jumped on them. But then it had a bumpy ride. It actually went lower at some point, and now it's coming back up because it's a basically sound company that went on sale. But that's why this was in there. And I don't love Yeti enough to do it. This was just, it's like, why would I not sell these $65 puts for $7? It just made no sense not to do that at the time. It was just stupidly cheap. And that's what happens. You know, we read the news like this, and I say, is that actionable? Do I understand this? Do I understand what's happening well enough here that I would understand how it affects the stock? Well, how could I not understand this? Pfizer is selling $54 billion in COVID vaccine revenue next year. Their entire revenue for before COVID was $40 billion. So they're going to be at $94, $95, $96 billion in sales. And analysts are saying $77 billion. They're missing it by a mile. And you know what's going to happen? All next year. Pfizer beats estimates. Estimates adjusted up. Analysts retarget. Blah, blah, blah. All next year. So, and then when do I worry about Pfizer? I worry about Pfizer when somebody has a better cure, when they don't need booster shots, when they say, okay, your immunity carries over longer. When I see that the downtrend in the vaccines is going to happen, but that's not obviously happening yet. Next year, they're going to sell $54 billion. Not this year, next year, $54 billion. So for 2022 already, there's no projection. So I know for a fact that I'm safe for now because next quarter, they haven't adjusted their expectations yet. Only when the analysts begin adjusting their expectations for next year and we start looking at 2023 do we have to worry about maybe we're too far ahead of ourselves. But until then, it's going to be upside surprise, upside surprise, upside surprise until the analysts catch up with the facts. But they're right there. If you were a good analyst, you would know these facts. There are very, very few good analysts out there. All right, there you go. That's the end of the webinar. I hope we learned something. Oh, when would you double down on ES based on your current entry? Uh-oh, that sounds, oh my God. Holy shit. I took a $1,000 hit on this. 46.50 for 46.50. Yes, I would definitely sell some more at 46.50. So let's say, Larry, we'll see how this goes in the webinar. Holy heck, can't even get it to 46.50. So if we get 46.50, 4650, All right, so we'll sell 2 more there. So if we hit 46.50, which I guess we already did hit. No, we didn't. If we hit 46.50, I'll sell 2 more because we're at $1,000 loss. I don't mind being at $1,000 loss, although that was unfortunate. I wasn't paying attention. But $1,000 loss I can stand, so that's okay. And then we'll be there, and then hopefully it stops around this line. But yeah, that's nasty. That took a huge spike up. That's crazy. So we'll see what happens next week. I'm gonna leave this like that for now and see if we fill it. If we fill it, I'm gonna now. If we fill it though, my average, because we're in at 46.22 here. If we fill it, the average is going to be 22 and 50 is 72, so 36. So the average will be 46.36. That means that when we get to 36, when we get back to 36, I'm going to sell 2, and that means we'd be flat at 36. And so all it would have done is raise the basis. And then the next time, once it's at 36, I would probably set a stop if it goes too far over 50, and otherwise we're just looking for the profit on the way down. And Tim says no volume. That's right, Tim. That's a good thing to watch, is whether or not there's any volume to this thing. But this is just a spike up on headlines people are reading in the news and whatever, and it's no basis. Wow, look at that. Oil hit 80. That's a good, that you can play long, frankly. It's got to be bouncy off of 80. We did have a bit of a bounce off of 82. I'm sorry, where's 82? We had a little bounce off of 82. You got to get a bounce off of 80. That's crazy. And see how 81 got bounces too. Even 81 got a bounce. You're always going to get a bounce at a whole number line on oil. Now, whether it's a big bounce or not is different. Remember, there were supposed to be 60-cent bounces that we were looking for, and here's 50 cents, and it failed. Holy crap, poor oil people. All right, anyway, so that's the end of the webinar. Wow, that's some batshit crazy stuff. Oh, I'm sorry, because Powell's speaking. I forgot all about him. God. He's probably doing a spinny job. I'm sorry, I was paying no attention. I forgot all, nobody reminded me that Powell speaks. Although we were having fun, right? We were going over some good stuff. Twitter. Maybe later. Twitter. Searching Twitter for Powell. Powell. Not Janie Powell. Okay, let's see. Risk appeared skewed towards higher inflation. Ooh, he actually said that? We're going to take several months to taper, and we're nowhere near hiking. There you go. We're nowhere near hiking from current levels, which tied last cycle to the lowest nominal levels in U.S. history. Powell's extremely defensive and stressed whenever anyone questions inflation. Yeah, Powell's extremely defensive and stressed whenever any question of inflation. Yeah, no shit, because he's lying out of his ass. Maximum employment has to be a level consistent with stable prices. Unemployment cannot be low. People are holding themselves out for labor, blah, blah, blah. Powell's press conference, just seeing if there's any good commentary here. Powell, we haven't focused on whether we meet the liftoff test because clearly it had not been met on the employment side. See, this is what Twitter's generally good for. Powell, Q&A, issue is how persistent is tight labor market when so many people holding themselves out of the labor market because of COVID and caretaking? I don't agree with that anymore. I am, the caretaking thing, yes, it's a school issue, and we really have to address that if we want people in the labor force. But companies can address that. There was a period where companies were starting to put in daycare centers and stuff. Gold edged up from its daily lows, blah, blah, blah. No. All right. So nothing. Another shorter Powell transition. Haven't asked whether liftoff appropriate since the Fed met the employment thing. We don't meet the liftoff test because we're not at maximum employment. If that's his benchmark, we are never going to raise rates. That's basically what he's saying. Because if they don't think this is maximum employment, there are more jobs available than there are people who are unemployed. That's what a labor shortage is. Right now, the total number of people who are unemployed in this country, which is, I forget how many, whatever, 5 million, 10 million, the total number of people who are unemployed is lower than the number of job openings that are posted. It's just the wrong jobs. People don't want these jobs or don't want these wages. So they have to, at some point, raise wages enough to get people to take the jobs. And by the way, it's not political, and it's got nothing to do with aid or whatever. It's like when someone says, "Would you do a job?" Okay, hey, would you work? Would you help me? Would you mow my lawn? And you're like, no. Would you mow my lawn for $20? No. Would you mow my lawn for $50? No. Would you mow my lawn for $1,000? Yeah. Where's the mower? There's a number. You need a job done. You pay the number. If you really need it done, you pay the number. That's how employment works. That is how you're supposed to have labor. Everything is not supposed to be skewed to management. The laborers are supposed to get a fair wage. They are supposed to be able to negotiate a wage. We have destroyed that. And one of the things they talk about a lot of stuff about Reagan, but the biggest thing Reagan did was he wrecked labor's position by when he came in and fired the air traffic controllers and broke that union. He broke all unions, basically. He just said, look, the government is not there for you if you're a union anymore. So you're all on your own. And unfortunately, when you say the union's on their own and the corporations get to negotiate and make rules, the unions lose all their power. The unions need the courts and the government to enforce some sort of fair labor practice and fair negotiating, because the companies have lawyers and people and specialists and lobbyists and blah, 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 and they are always going to win. And then one wage sets another wage, right? You have choices of wages. Now, again, if I was starving to death, if I was homeless and you said, can you mow my lawn for $20? I might say, yeah. How long does it take me to mow your lawn? 2 hours, 3 hours? I spend 3 hours mowing your lawn. I get $20. That pays for my food. I got to find something else to do that's going to pay for me to sleep somewhere tonight. But that's my economics says that $20 means something to me. You okay? But you asked Phil Davis to mow your lawn, and I'm going to say no until it gets to a number. And honestly, that number, I wouldn't do it for $100. I'm not going to spend 3 hours mowing somebody's lawn. $200. I'd really have to think about it. $200. I'm like, what else am I doing for $200? What else am I doing for 3 hours? What's really worth it? It starts to get to a point, and then it gets to like $300, $100 an hour. I'm like, I don't know. I mean, it's like it's exercise. I could get out there and make some money for, mowing the lawn. I could go out to a nice dinner. It's like there's a number though. There's always going to be a number. And that's what the labor shortage is. The labor shortage is not a shortage of available workers, and it's not about mismatching jobs, because my job skills are obviously better than the average lawnmower. Although maybe not particularly at lawn mowing, but I actually did mow lawns way back in the day when I was a kid. I started out mowing. I'd mow my dad's lawn. He would pay me. Then I would do my neighbor's lawn. He started paying me. And then I did another neighbor's lawn. And then I had to go buy a lawnmower because my dad was complaining that I was taking his lawnmower all the time. But I went out and bought myself a pro lawnmower, which was better than my dad's mower. I was like, screw you, Dad. I get myself a really good lawnmower, which was wider and faster and so on and so forth. And then I was like ripping through the lawns. And I had then by the end of the summer, I had like 10 different people's lawns I was doing, making good money. My first entrepreneurship. So, but anyway, so that's my example. And back then, I think I did get $20. I'm pretty sure $20 was the going rate. But the point is, it's a mismatch of skills, but it's not really a mismatch of skills, because if you tell me, if I'm unemployed and you tell me you'll pay me $50 an hour to be a dental assistant, I'll freaking go learn to be a dental assistant, right? It's like $50 an hour. Not me, but I mean somebody who needs that kind of money. $50 an hour is a couple of thousand a week. It's a $100,000 job. So how do I learn to be a dental assistant? How much time will it take me to do that? How can I do that? Is there training available? That's what happens. Is there training? Can people afford to do this? Is there help available? These are the things that you have to work on to improve the labor force, not just paying money. You have to have access to these things. Then you get into the issues like childcare and things like that. And these are the issues that the Democrats are all worried about, whereas the Republicans are just like, basically like, oh, go take a job, you son of a bitch, you lazy bastard. It doesn't work like that. You have to fix all the little problems to get somebody to that job. And in addition, though, the job has to be worth taking in the first place. So Powell is saying full employment. You can't wave a wand and make full employment. You have to build it, and the Democrats are fighting a real uphill battle trying to get those investments made in our future workforce, which is exactly why we have this problem in the first place. No one ever invested in jobs and training and so on and so forth for the future workforce, and we knew this, and they told you this. You heard it 100 times in the last 10 years that the future of the workforce depends upon flexibility. That flexible workers need to get used to changing jobs and changing careers on a regular basis based on the need, because society shifts on a regular basis. You were told this. You know that's true. And now it happened. Something happened, and the workforce had to shift, and we were not at all prepared for it because we did nothing. We didn't make the investment we needed to have a flexible workforce, and we got killed by it. And our solution is no solution at all. We're not fixing the problem. Anyway, all right, I'm over time. I got to go. Thanks, everybody, for coming. I appreciate it. Have a great day, and we'll have another one out next week. All right, take care.